Imagine for a second, what does $1 billion actually look like? It's a number so large our brains can't really process it. It's not just wealth, it's a gravitational force, bending the world around you to your will. It's the kind of money that means you don't own a jet, you own a fleet. You don't just have a nice watch, you have a collection that could fund a blockbuster movie. It's the ability to treat $100,000 stacks of cash like pocket change, a prop for an Instagram photo. This isn't just financial freedom, it's financial fantasy. A level of success so absolute, so stratospheric, that the normal rules of money, the ones you and I live by, simply shouldn't apply. The concept of a budget, of worrying about a bill, of checking your account balance, it all seems absurd, a relic from a different reality. You've reached the financial endgame. You've won, right? So then, how do you operate in that reality, with over $1 billion in career earnings, and still end up dealing with money problems? How does the person who seemingly conquered the world of money find themselves in a fight with it? Now let's be very clear. This isn't another tired story about a celebrity going broke. This isn't about lavish spending leading to an empty bank account. The tabloids love that narrative because it's simple, it's dramatic, and it makes us feel a little better about our own finances. It's a modern-day fable, but the truth here is far more complex, and frankly, far more important. It's a story about something way more dangerous, a hidden trap that's buried deep within our entire culture of money, a trap that's almost impossible to see when you're in it. It's a problem that doesn't just affect superstar athletes or A-list celebrities with entourages and private chefs. It snares Wall Street traders who move millions before breakfast, and successful entrepreneurs who build empires from scratch. It impacts investors who think they've diversified perfectly, and it absolutely, 100% affects you. Whether you're managing a six-figure portfolio or just trying to figure out how to pay your bills and save a little on the side, this fundamental misunderstanding of money is quietly sabotaging your financial life, often without you even realizing it. Because the biggest, most pervasive, and most destructive lie in the world of money is this: if I just make more, everything will be fine. We tell ourselves this every day. If I just get that raise, if I just close that deal, if I just have one winning trade, if I just hit that next income bracket, then the pressure will be off, then I'll be secure, then I can relax. It's the gospel of more income, more revenue, more profit. We chase it relentlessly, believing it's the cure-all for financial anxiety. But what if it's not? What if in many cases making more money simply amplifies the underlying problems you already have? What if it's like pouring gasoline on a fire you didn't even know was burning? Today, we're going deep. We're not just telling a story, we're dissecting a masterclass. We're breaking down the financial reality behind one of the highest-earning athletes in history, Floyd "Money" Mayweather Jr. We're going to use his incredible career not to judge, but to learn, to understand the critical, life-altering difference between high earnings and actual wealth. This is a lesson in the brutal mechanics of cash flow, the non-negotiable reality of taxes, and the hidden architecture of what it truly means to build, and more importantly, keep a fortune. Because earning $1 billion is a historic achievement, but keeping it is a completely different skill set. This isn't just about how to get rich, it's about how to stay rich. And the principles we're about to uncover apply whether you're earning $1 billion a decade or trying to build a secure future on a regular salary. This is the financial education you were never given, and it starts right now. To understand the financial labyrinth of Floyd Mayweather, you first have to understand that he didn't just become a boxer, he became a brand, but not just any brand. He engineered one of the most lucrative and polarizing personas in sports history. In his early career, he was known as Pretty Boy Floyd, a defensive prodigy, a boxing purist, untouchable, and technically brilliant. His skill was undeniable, but it didn't always translate to blockbuster paydays. The problem with being a defensive genius is that, to the casual fan, it can look boring. There were no wild brawls or dramatic knockouts. So, in a stroke of marketing genius, he killed Pretty Boy and gave birth to Money Mayweather. This new character was everything Pretty Boy wasn't: loud, arrogant, and obsessed with wealth. He flashed stacks of cash, boasted about his cars and jets, and surrounded himself with an entourage called the Money Team. He wasn't just a fighter anymore, he was the villain you'd pay any price to see lose. And that was the entire point. The foundation of the Money brand rested on three pillars. The first and most important: undefeated. An undefeated record in boxing is the ultimate currency. It's not just a statistic, it's a marketing machine that creates an aura of invincibility. Every single fight became a high-stakes event built around a single billion-dollar question: is this the night he finally loses? That question alone sold millions of pay-per-views. The second pillar: strategic. This wasn't just about fight strategy in the ring. It was about career strategy outside of it. Mayweather was a master of timing, opponent selection, and building public demand. He would let rivalries simmer for years, waiting for the precise moment when fan anticipation and the potential purse was at its absolute peak. He controlled the narrative, making the world wait for him. The third pillar: precise. This described his boxing style, a defensive master who hit his opponents far more than he got hit. But it also defined his business acumen. He was precise in identifying every possible revenue stream and meticulous in negotiating every last detail of a contract. But more importantly, he positioned himself as the highest-paid athlete in the world. To do this, he had to completely shatter the existing business model of boxing. For decades, the structure was simple. A powerful promoter, like Don King or Bob Arum, ran the show. They found the opponent, booked the venue, secured the TV deal, and covered the upfront costs. The fighter, even the champion, was essentially a high-paid employee. They would get a guaranteed purse, a large one to be sure, but the promoter took on the risk and in return kept the lion's share of the upside. If a fight massively overperformed on pay-per-view, it was the promoter, not the fighter, who reaped the biggest rewards. Mayweather saw this fundamental flaw in the system. He realized his undefeated record and his villain persona gave him something more valuable than any championship belt: leverage. He wasn't just fighting opponents, he was fighting for leverage. In 2006, he made a pivotal decision. He paid a reported $750,000 to buy himself out of his contract with his promoter, Top Rank. At the time, people thought he was crazy. Why give up the security of a top promoter for a one-time fee? But Mayweather was playing chess. By becoming his own promoter, he flipped the entire power dynamic. He was no longer the employee, he was the CEO. He founded Mayweather Promotions, and from that point on, he didn't just fight in the main event, he the main event. He controlled everything. This is where the numbers get staggering. Let's talk about pay-per-view splits. In a typical fight, the revenue from a $70 PPV buy is first split with the cable and satellite providers, who take about 50%. The remaining $35 is then split between the promoters. In the old model, Mayweather's promoter would take their cut, and he'd get what was left. But as his own promoter, he negotiated directly. Instead of a flat fee, he demanded a percentage of the gross revenue. For his biggest fights, he would command the A side, taking a favorable split, often 60-40 or even more, against his opponent. He was betting on himself, and because he never lost, he always won that bet. This single change meant that for every fan who bought the fight hoping to see him lose, a significant portion of their money went directly into his pocket. Then came promotional control. Being the promoter meant he controlled every other revenue stream associated with the event. This wasn't just about the fight itself. It was about ownership of revenue streams. We're talking about international television rights, where the fight is sold to broadcasters in dozens of countries. Closed circuit rights, for bars and theaters showing the fight. All the sponsorships you see plastered on the ring canvas, from the corner posts to the fighters' shorts. The ticket sales from the live gate, which for a Vegas mega fight can exceed $70 million. Merchandise sales. Everything. Instead of these being line items that padded his promoter's pockets, they became direct deposits into his own. He was no longer just taking a slice of the pie. He owned the entire bakery. One fight could generate hundreds of millions. Take his 2015 bout against Manny Pacquiao. The fight generated a record 4.6 million pay-per-view buys at roughly $100 each. That's $460 million before a single ticket was even sold. Add in a $73 million live gate, foreign rights, and sponsorships, and the total revenue soared past $600 million. And unlike most fighters who would get a fixed, albeit massive, payday, he structured the deal to take the biggest cut. After all the costs were paid, reports estimate Mayweather's personal take-home for that one night's work was over $250 million. That's more than the annual GDP of some small countries, earned in a single evening. He had built a system where his earnings weren't just a salary, they were a reflection of the total success of the event he single-handedly created. From the outside, this looks like financial perfection, the ultimate success story. Make massive money by building an empire around your own talent. Stay undefeated, cementing your legacy as one of the greatest of all time. And with that money and status, live however you want, with a lifestyle that most people can only dream of. It's the blueprint for athletic and financial dominance. A flawless victory, inside the ring and on the balance sheet. It was a masterclass in maximizing earning potential, a strategy that other athletes would soon try to replicate. He had mastered the art of generating income on an unimaginable scale. He wasn't just earning money, he was printing it. The money persona wasn't just an act, it was a business strategy that paid off spectacularly. But here's where the story shifts. Because mastering the art of making money is only half the battle. The other half, the much harder half, is keeping it. And as we'll see, the very same larger-than-life persona that generated hundreds of millions of dollars also created a vortex of expenses that threatened to swallow it all. The image of financial perfection was just that, an image. And behind the curtain, the numbers told a very different and far more precarious story. Over time, reports started surfacing. Tax issues, legal disputes, unpaid obligations, not once, but multiple times. And that's where most people get confused. How can someone who made that much money have these kinds of problems? The answer is simple, but uncomfortable. Income and financial stability are not the same thing. Let's break this down in real terms. Imagine you make $10 million and sounds like you've made it, right? But what if 30% goes to taxes? Millions go into lifestyle money is tied up in assets. Suddenly, your actual cash position looks very different. You don't go broke because you didn't make money. You go broke because you ran out of accessible money. Here's a concept most people misunderstand. Net worth is not cash. You can own real estate, luxury items, business equity, and still not have liquidity. That means when bills come due, or taxes hit, or lawsuits appear, you need cash, not assets. Now layer in lifestyle. Private jets aren't one-time purchases. They come with maintenance crew fuel, luxury apartments, that's recurring rent or massive overhead. Jewelry, often financed, or not as liquid as people think. What starts as success becomes a system that requires constant income. Now let's bring this back to you, to the world outside of corporate boardrooms and billion-dollar balance sheets. Because the fundamental mistakes we've been dissecting, the confusion of net worth with liquidity, the failure to manage cash flow, the siren song of leverage, these aren't exclusive to giants. They are universal principles of financial gravity, as real and unforgiving as the physical gravity that keeps us on the ground. They happen every single day, just scaled down to the level of the individual. It's the same story, just with fewer zeros at the end. Think of it like this. A small, slow leak under your kitchen sink can, over time, cause just as much structural damage to your floor as a burst dam can to a valley. The scale is different, but the destructive process of unmanaged outflow is identical. This happens to freelancers who land a massive project, to small business owners who have a record-breaking quarter, and most acutely, it happens to traders in the financial markets. Why traders? Because the market offers an intoxicating combination of immediate feedback and near-infinite leverage, amplifying both gains and the psychological biases that lead to ruin. Let's walk through a scenario that is tragically common. Meet a hypothetical trader. Let's call him Alex. For 2 years, Alex has been diligently learning, trading part-time, and making modest, hard-won gains. He respected risk and followed his rules. Then, he hits a hot streak. He's been selling puts on a popular tech stock, and the market has been on a relentless tear upwards. Every contract he sells expires worthless, and he keeps the full premium. It feels like free money, an ATM that never runs out. In one quarter, he nets $50,000, more than he makes in 6 months at his day job. This is the moment the psychology shifts. The $50,000 isn't just money, it's validation. It's proof that he's cracked the code. The Dunning-Kruger effect kicks in with full force, propelling him to the peak of Mount Stupid, where his confidence vastly outstrips his competence. He's no longer just a guy with a side hustle. In his mind, he's a market wizard. He starts calculating his annualized returns, projecting a future where he quits his job in 6 months and trades from a beach in Thailand. His confidence, once earned through careful study, metastasizes into a dangerous, blinding overconfidence. So what does he do? He increases his size. The strategy that made him $50K is clearly the golden goose. Why sell 5 contracts when you can sell 20? Why risk $10,000 when you can leverage your account and risk $100,000? He stops taking profits off the table. Every dollar of premium collected is immediately recycled back into the next trade, compounding his position size. He's not building a business with sound financial practices. He's placing a single, ever-growing bet, convinced the roulette wheel will only land on his number. And then what happens? The market, as it always does, changes its mind. But before the market even turns, the invisible cracks are already forming. The foundation of his supposed success is riddled with structural flaws. First, there's no tax planning. That $50,000 gain, in his mind, it's all his. He's already mentally spent it on a down payment or a new car. He hasn't considered that a significant portion, maybe $15,000 or $20,000, belongs to the government. He hasn't made any estimated tax payments. That profit is a phantom, a liability disguised as an asset on his screen. It's not his money. It's a short-term, interest-free loan from the IRS, and they will come to collect. Second, there are no cash reserves. Because he's compounding every dollar back into the market, he hasn't built a fortress. He hasn't skimmed 20% of his winnings and put it into a separate, untouchable savings account. His business, the trading operation, has zero liquidity. Its survival is entirely dependent on the next trade being a winner. He has no dry powder to weather a storm or to seize new opportunities when they arise. And that leads to the third and most critical failure. His capital is fully deployed. Every single dollar available in his trading account is being used as margin to support his massive, concentrated position in selling puts on that one high-flying stock. He is all in. He has maximum exposure with zero buffer. He's standing on a financial knife's edge, convinced it's a wide, stable path. This is the gambler's fallacy in action, believing that a streak of good luck implies future success, while ignoring the underlying risk. Then comes the catalyst. It doesn't even have to be a crash. Just one bad drawdown. The tech stock that could do no wrong suddenly misses earnings. The CEO says something foolish on a conference call. A competitor releases a better product. The stock drops 15% in a week. The market doesn't care about Alex's plans for a beach in Thailand. For Alex, this isn't just a paper loss. It's a catastrophe. The puts he sold are now deep in the money. His account is flashing red. He gets a margin call. His broker is demanding more cash to cover the potential losses on his position. Cash he doesn't have, because it's all tied up. This isn't just one bad cycle. It's the inevitable mathematical consequence of his flawed system. The risk he ignored has finally materialized. And right at that moment, as if on cue, the universe delivers the final blow. His accountant calls. The tax deadline is approaching, and he owes $18,000 on those gains from the previous quarter. One tax bill, arriving at the worst possible time, demanding real cash to pay for profits that have already evaporated. And now you're scrambling. He's forced to liquidate his losing positions at the absolute worst price. locking in devastating losses just to meet the margin call. He has to drain his personal savings to pay the tax bill for money that no longer exists. The $50,000 gain has vanished, and it took another $30,000 with it. In the span of a few weeks, he's gone from feeling like a genius to being completely wiped out, his account shattered, and his confidence in ruins. He didn't fail at trading, he failed at business. He failed to manage the fruits of his success, and in doing so, ensured his own downfall. So what's the fix? It's not complicated, but it requires unwavering discipline. Here's the three-part system to protect your earnings. First, remember that every win is not fully yours. Treat taxes like a bill and pay them immediately. Second, always have accessible capital. This money is not invested, not locked away. It must be available. And third, don't let temporary income create permanent expenses. Contrary to what some might think, Mayweather didn't fail financially. Instead, he revealed a profound truth most people don't want to admit. Making money is the easy part. Keeping it, structuring it, and controlling it, that's the real game. And the higher your income goes, the more financially dangerous your mistakes become. If you understand this now, you're already ahead of most people. Because wealth isn't built on big wins, it's built on control. If you want more breakdowns like this, real money lessons from real situations, subscribe to the channel. Because the goal isn't just to make money, it's to keep it.